Deal analysis is probably the most important part of being a successful real estate investor, but luckily it does not have to be hard. For most metrics and calculations that you need for deal analysis, it's actually really simple. It's stuff like multiplication and division. I mean, this is like middle school stuff here. But there are a lot of metrics and a lot of acronyms that can get a little bit confusing. There's cash on cash return, return on investment, cap rate, internal rate of return, net present value. There's a lot of business jargon and it's kind of this alphabet soup. So what winds up happening is people kind of lose track of all the different options that they have, and maybe they fall in love with one metric that they get to know and understand, and that's all they use for their investing. For me, early in my career, that was cash on cash return. At that point, I really just wanted more money in my bank account at the end of each month. I just wanted to know, was it going to be $200, $300 a month? What was it? So I just focused on my cash flow. But you can't just use one metric. It's fine maybe at the beginning, but if you want to be a good investor or a great investor, you have to really understand all the different metrics out there, because each common real estate investing metric has a distinct purpose and it helps you answer a really important question. Like there's all these different questions investors constantly have to be asking themselves, and each metric is aligned with one of those questions and helps you answer that. But failing to learn what metrics apply to what situations leaves you flying blind, and that can lead to uninformed and sometimes bad decisions. So to me, the key to being a confident investor, especially in this type of confusing economic climate that we're in, is about knowing your numbers cold. So you just have to know how to analyze deals like a pro, which sounds hard, but it is not. And you just basically need to know which metrics to use to evaluate your next deal. And I'm actually going to even show you a framework that I developed with the great investor, Jay Scott. It's called the Metric Matrix. You can see it right here. And this will ensure that you're always prepared with the right answers to your most important investing questions. Hey everyone, my name is Dave Meyer. I'm the Vice President of Data and Analytics at BiggerPockets, and I am also the author of a brand new book called Real Estate by the Numbers. I co-wrote it with Jay Scott, and it's all about how to analyze deals like a pro and all the numbers and concepts and important things that you need to know to think and act like a successful investor. It's on pre-sale now, which is really important because during the pre-sale period, if you buy it right now, you can actually be entered to win coaching calls with either Jay or myself. You can attend a live Q&A webinar, and we have a whole bunch of other giveaways just for the people who buy it during the pre-sale. You can also use the code DAVE, that's D-A-V-E, like my name, for 10% off right now. That's just for the next couple of days. So if you want the book, and you can go do that now. There's a link in the bio. It's biggerpockets.com/store. So go check that out. Let's just frame this by saying that often people calculate metrics for investments without really thinking about what question they want to answer. Maybe they've just heard of something like cash on cash return and they go and see one is higher than the other. Maybe one deal has a 7% cash on cash return, the other one has 5%, and you pick the 7. But do you really know what cash on cash return is, or why you're using that metric instead of all the other metrics that are out there for real estate investors to use? So really the first question in picking the right metric is thinking hard about the question you are trying to answer for yourself. For example, at some point during your investing journey, you may be looking to answer the question, how much money will I make from this investment? Now, that's a great question. There are easily calculated metrics to answer this question. But what if instead of that, I asked you, what percentage of my initial investment will this deal return? Also easy metrics, but totally different metrics. You can't answer those two questions with the same metric. Or third, maybe you want to know what percentage of my initial investment will this investment return per year. Again, you're going to need different metrics. Or what if you want to know if you're going to factor in the time value of money or compounding into your returns? Again, you'll need a whole new set of tools. So it's not like there's this best metric or perfect metric out there. There's no right metric. There's no wrong metric. It's about the questions that you're trying to answer. So you have to first think about the questions that you want to answer for your next deal or during your deal analysis. Let's look at a quick example here. So let's just say that you buy or want to buy a traditional buy and hold rental property. One of the first questions you're probably going to ask yourself is, how much money is this making me in a year, right? That's a pretty simple question. And for that, you'd probably want to use cash flow, right? You can see the formula for cash flow right here. Cash flow is basically all of your rent income minus all of your expenses. Super simple, right? That's just subtraction and addition. So you can see this is not hard to calculate if you know the question that you want to answer. And the question here, again, is how much money is this going to make? And if I had a deal and I knew what my rent was and my expenses were, I could figure out what my cash flow is. And this is, of course, just one example for buy and hold rentals. If we're investing in a multifamily or a syndication, we'd probably use another metric that answers the same question called net operating income or NOI. Same thing with flipping. If you wanted to know how much you were going to make in a flip, you wouldn't use cash flow and you wouldn't use NOI, you just use profit. So these are three metrics that you can use if you want to answer the question, how much money is this investment making me every single year? All three of them can answer that depending on the situation, right? So let's take this example one step further. Let's just say, every buy and hold deal, it's not just about cash flow. You also have all these other benefits to real estate investing like appreciation and amortization and tax benefits. And so maybe what you want to know is how much of my investment will get returned to me when I sell my property, right? So you hold on to the property for a while, you're getting all these benefits. You can't use cash flow for that, right? Because we need to figure out how much the property appreciated, how much the loan was paid down. You need a new metric for that. And for this, the simplest metric you can use is return on investment or ROI. Almost everyone's heard of this term, but if you don't know how to calculate it, I'll put it up on the screen. ROI is basically you take what you sold the property for, you subtract what you bought it for, and then you divide it again by the amount you bought it for. So just an example, let's just say that you invested $200,000 and you go and sell the property a couple years from now, and now it's worth $300,000. That's a 50% ROI, right? So if you want to do the calculations, you can follow along, but that's a 50% ROI. That's pretty good, right? So this is the same deal, but now I'm asking a different question. Instead of asking how much money is this going to make me per year, I'm asking it what percentage of my initial investment am I going to get back at the end of my deal? And so that requires ROI. Same deal, different question. And with a different question, we need a different metric. Now let's continue this example. What if you wanted to compare two deals against each other? For example, if you had a deal you owned for 3 years and got a 40% return on that, is that better or worse than a deal you owned for 7 years and got an 80% return, right? So you have one deal, 3-year hold, 40% return. Second deal, 7-year hold, 80% return. Which one is better? Well, for this, we need a whole other metric. You need to be able to calculate ROI, but calculate ROI by year so you can compare these two deals with different hold periods against one another. So for this, one common way to do it is using something called an annualized ROI. For annualized ROI, the formula is right here. It's just ROI divided by the number of years held. So for deal one, where we held it for 3 years and got a 40% return, you just divide 40 by 3 for a 13.3% annualized ROI. That means your ROI on average is 13 and change per year. For deal two, we divide 80 by 7 and you get an 11.4% ROI. So using this metric, we can now see which deal is earning better results per year. Deal 2 had a better total return, but deal 1 was earning us more on a yearly basis. So you can see why this is important, right? Because if you just did ROI, you might choose deal 2. But now that you're asking a new question, which is which deal is better per year, you can see that deal 1 is actually better per year. And there's no right or wrong answer here, but now because you're asking more questions, more good questions, you're getting more information with which you can make a confident investing decision. Lastly, with this example, let's just hypothetically say let's just complicate the deal basically. So for example, let's just say you bought a new deal for $100,000 and you get $2,400 in cash flow per year, and you invest another 75 grand into making capital improvements, but you don't do that until year 5, then you sell it for 300 grand, you 1031 exchange it. What's the ROI on that? That's not so easy, right? You have multiple inputs of cash, you have multiple outputs of cash, and for that, I would recommend you use a more complicated metric called the internal rate of return. I'm not going to get into how to calculate this. It's super hard, and actually it's almost like nearly impossible to do by hand. You have to know how to do it in Excel. But this is a metric that most advanced investors use to evaluate complex deals because it takes into account the effects of compounding and the time value of money, to super important concepts that you should know as an investor. So it's a great metric to learn. But for example, if you were flipping a house, you might not need to use something super complicated. Or if you're just buying a turnkey property, maybe you don't need IRR. This isn't as sophisticated. But if you're going to do a BRRRR deal, IRR is a great metric that you should be using to evaluate different deals. Hopefully from these examples, you can see that there is no one right answer. It's about knowing the questions you want to answer and then applying the right formula. To help make this easier, as I showed you above, Jay and I created the metric matrix. It's right here. And you can see we've created this basically chart that shows you which formulas answer which of the 4 questions that we just posed to you. So you can look at when to use profit, NOI, cash flow, return on investment, equity multiple, capitalization rate. So these are more metrics than we talked about today, but hopefully this will be helpful to you because you can see when these metrics are useful to investors. So we also have cash on cash return, average annual return, compound annual growth rate, and internal rate of return like we talked about. It's a super handy guide that you can use whenever you want for figure out which metrics are best for the questions that you're trying to answer. And you can refer back to this anytime you want when you're going out there looking at deals and trying to analyze. Remember that the key here is to make sure you don't fall in love with and come to rely on just a single metric. Investing is unfortunately more complicated than that, but fortunately, the metrics are pretty easy to calculate if you know when to use them. The truth is, the principles behind deal analysis are the same, and they're not that hard to know, and they're the same, honestly, if you're doing a house hack, if you're doing a single family rental or a huge development project. You just need to learn when to apply these different ideas and how to do the really simple math. That's what it takes to become a confident investor. So again, we do have this pre-sale going on right now. You can get 10% off and enter to win coaching sessions from Jay and I, attend this live Q&A we're doing. There's a bunch of different prizes. Just use the code DAVE, D-A-V-E. Go to biggerpockets.com/store to check that out. Thank you all so much for watching. And if you want to have any questions for me about this video, any feedback from me, make sure to hit me up on Instagram where I'm at the Data Deli. Thanks again, and I'll see you next time.